How is the expense ratio calculated? Have you ever wondered how banks and credit unions measure their efficiency? One key metric they use is the expense ratio. This ratio helps them understand how well they manage expenses compared to their income. So, how is this ratio calculated? Let's break it down. There are two main types of expense ratios that financial institutions focus on: the efficiency ratio and the operating expense to average assets ratio. First, let's talk about the efficiency ratio. This ratio is calculated by taking the total operating expenses and dividing it by the total income minus interest expenses. For example, if a bank has total operating expenses of $1 million and total income of $2 million with interest expenses of $500,000, the calculation would look like this. You would subtract the interest expenses from the total income, which gives you $1,500,000. Then, divide the total operating expenses of $1 million by this result. The efficiency ratio would be approximately 0.67. Now, in the context of credit unions, the calculation slightly changes. Here, the efficiency ratio includes non-interest income in the denominator. So, if the credit union has interest income of $1 million, interest expenses of $300,000, and non-interest income of $200,000, the calculation would be as follows. First, subtract the interest expenses from the interest income, which gives you $700,000. Then add the non-interest income, resulting in $900,000. Finally, divide the total operating expenses by this total. Next, let's look at the operating expense to average assets ratio. This ratio is calculated by dividing total operating expenses by average total assets. For instance, if a bank has total operating expenses of $1 million and average total assets of $10 million, the calculation would be straightforward. You would divide 1 million by 10 million, resulting in 0.1 or 10%. Understanding these ratios is essential for both banks and credit unions. A lower efficiency ratio indicates better management of expenses relative to income. This can be appealing to members and investors alike. The operating expense to average assets ratio helps assess how effectively the institution uses its assets to manage expenses. By keeping an eye on these ratios, financial institutions can improve their operational efficiency and reduce costs. This ultimately leads to better services and returns for their members. So, next time you hear about expense ratios, you will know exactly how they are calculated and why they matter in the world of personal finance.